At this time, I'm going to introduce our special guests from the Edmond, Oklahoma City area, Steve Van Horn, and let's get our.
Do I get to hold the stick?
Yeah, absolutely. In fact, some of you may remember. I'm glad you did that. Listen to this. Read what's on this stick. Read it out loud.
The beatings will continue until morale improves.
Okay. I got this from Glenn Wright, one of our former partners. Glenn used to give these to all his employees. He gave me one. So,
Good man, good man.
tribute to Glenn. Okay, there we go. Steve, take over.
Well, thank you, Scott, for letting us come. And I've known Scott for a long time and have done some deals with him and helped him along the way. And very excited. We just kind of ran into each other, and this deal fits our timeline of what we're doing. On the back is just a quick bullet overview of this that you're going to see. And Scott had told you that two of the people here are my sons, and we have a team of people that, from money people and team of our geologists, engineers that we partner with. Kyle's our CPA here today. But what we're doing is we've got ourselves. You'll see in a second. We've got ourselves a production package, and based on just the numbers that we have 5 years of data that these guys have taken and ripped apart and examined. It's located here. If you don't know, this is the Scoop part of Oklahoma. So you're down here in Love and Carter County. That's the Scoop. This is the stack up here. This acreage that we're talking about is up here in the north stack. So up on the north part of the state in the Sooner Trend, which the Sooner Trend, if you were around in the 80s, it was you pop a hole and it makes a well. It was the investor's dream. The Sooner Trend was. There's wells all up there. It's the area where they tried a lot of the horizontal Mississippis. Some were good, some weren't as good. And you'll see in our acreage package. I'll push this to switch it. There we go. So our company, Royalty Energy Development, we've been around since 2019, and we operate here. All of our wells are in Oklahoma in these counties. We operate 50 plus wells. What we've completed 7 acquisitions since December of 21. So we've been out, and they'll talk more about the strategy we use. We've been out finding properties that are producing, that have infill potential, properties that we can take and stimulate and bring the production up, but find things that are going to pay back and keep it, under a 5-year period. This particular package we think will pay back in 4 years or less, with $70 oil and $3 gas. So our group, I'm a landman, have been a landman for 40 years, so I understand the real value, and there's a huge value in this package with HBP property. We have thousands of acres that we're going to be able to do drilling and different things that we don't have to pay for. That's already there. Participate in other wells. You'll see inside of here there's 62 separate overrides. So these overrides came from this package is coming from a tier 1 operator. I can't tell you who, because we're still waiting on some papers to be signed, but it's a tier 1 operator here in Oklahoma. And a lot of these wells, they had production out there, and people came in to drill horizontals. They didn't participate. They just took an override. But we still own the acreage outside of whatever was pooled inside of that unit. So we have thousands of acres that's HBP'd by some people. We have a well there, other people have a well there that's a horizontal, but we have overrides in all those wells. And the overrides make how much, Caleb? $200,000 a year in just revenue that comes into this package. But all of our wells, we operate wells in all those counties, and then we'll be bringing this package in right here. Our group is taking at least 50% of this. Our other deals, we don't have any partners with our current production. We're going to be working with Total, and they can take up to 50% of the deal. And whatever they don't take, we'll take the rest of it. So we're in this same deal with you. It's a very exciting deal. Okay, Craig's going to tell you here about our strategy. You can have the stick now.
All right. Thank you guys for having us. I'm Craig Van Horn. So the 3 of us went to the University of Oklahoma, same time frame. I'm a couple years older than them, but what we began to realize, ever since I was a little kid, my dad's been using free labor at the courthouses to run records. So I've got a robust, a longer resume than what my age shows.
He's not lying. He's my oldest son. He was 12 or 13. I had him. You used to have to go to the courthouse and pull the books and do that. I had him in the courthouses very early on, running records.
And I was lucky enough to spend my formative years in Ada around a lot of small to middle-sized operators. I kind of understood how that game worked, and we moved to the Oklahoma City area when I was in middle school. So kind of a little bit of both worlds, where I saw bigger companies and how they operated, but was also around vertical, historical, conventional companies for the beginning part of my life. And when we were in school, what we realized is that there was a lot of our peers going to college to be engineers, landmen, different spectrums of the oil and gas industry, but they weren't really targeting conventional oil. They weren't learning about it. I have lots of friends who are geologists that can't map conventional oil because it's just not what was. They were targeting them to go to tier 1 operators and go be geologists and get a job so that it looks good on the job reports that come back from the school. So what we realize is there's a massive gap between new young workforce and what's made Oklahoma energy for the last 150 years, which is conventional oil. You have these older operators who are moving into retirement age and they don't have a succession plan. It's good acreage, it's good assets, they're low on the decline curve. And so we developed a strategy to go out and reach out directly to those operators that had conventional oil. We do have some horizontals as well, but it had to fit our model, which was shallow production, didn't make a whole lot of water. The decline curve was already built in. We kind of could map out exactly what it was going to do. Good operators who don't have a lot of workovers and don't have a lot of issues with their well bore. And so we began targeting those people in 21. I would say probably July of 21. We closed our first deal in December of that year, and then we since then have had 7 acquisitions in the last few years, just targeting those kind of people, as well as 1 private equity group with 6 horizontals in the Seminole area. And so that's basically what our strategy is. That's how we've gotten to this point, is that we've now have 50 plus operated assets, well bores current, active today, that we operate with our team, and have lots of, I would say 35,000 acres plus of HBP acreage within that, and this package fits into that same model. The only difference being it's not necessarily someone who's trying to ride into the sunset, but it's a tier A operator, same spectrum and footprint of assets though that fit our model. The other thing that we do is that once we get them, we'll go into this a little bit more later, but we have a pretty good system of evaluating these assets. Caleb has a finance background, Kyle is a CPA, so we can understand the numbers, and then I'm more of the field, hands-on guy that goes out there and can evaluate the equipment and how they run their operation. And then we've also utilized new technology that these assets have never seen before, including this package that we're going to talk about today, using downhole instrumentation to see what's going on in real time, making changes remotely, taking in additional data that hasn't really been possible until the last few years, where technology's gotten to the point where cellular data has gotten where we can send data back and forth from the well. But we do most of our stuff remotely. We can turn on and off wells, we can run timers down to the second, and do most of it from your computer.
Optimize the energy consumption.
So we'll go into detail a little bit later, but basically what we've been able to do is figure out exactly how long each well needs to pump for to have maximum efficiency. So whenever it starts to pump off, we shut it off remotely. And then also, we'll get into that a little bit later too, but it can also help us have an idea of what kind of issues we're running into in the future. So this is our evaluation process. Once we get under contract with a group of, we would like to look at their stuff, we get all of their historical LOS, some people call it LOE, it's just their financials, their JIBs, over the last 3 years. A lot of cases we'll get more than that. In this case we actually got 5, which is really helpful. So we take that and we average out over the years what their costs were and what kind of revenues they were getting from, less about revenue, more about production on, and then we actually hard code in the prices of $70 oil, $3 gas, just based on historical prices. That's the area that if we can make money at $70 oil and $3 gas, then we're going to be pretty happy with it. And if it can make money less than that, obviously we're going to be really happy. So we take that, we look at all of these different factors are what we would consider the most important, and then once we have a good, robust understanding of what these assets are, what kind of history they have, what kind of gas contracts they have, then we can make we have an internal valuation, and then we compare it to a third-party engineering, and that's how we've gone through our process of evaluating these to this point. Caleb is going to talk to you about some of the. You want to stick?
No.
Okay, all right.
Thank you. You can hold it. You can point for me. Thank you guys for having us. But so there's 33 operated assets in this package. There's, he mentioned earlier, an additional 62 overrides plus 34 non-operated wells. The 33 operated assets, the majority were drilled by the current operator, most of which have high working interest, above 90%, some 100%, and we're taking all of that plus their thousands of acres of leasehold that we see some potential in. The heart of this package is a 13-well, all lined in, operated assets that go to a central water disposal system, and that's the bulk of the production. Daily production comes from those. So right now in 2023, they're averaging 128 barrels a day and 700 MCF net. So blended across every well, blended across the working interest, that's our take-home net barrels per day. So it's a robust package, it's diversified, there's a really good central core system to it that we think as we develop, as we can drill new wells, there's additional capacity in the water, in the disposal system to take on those new wells if they were water producers. So we're excited about that. Next slide. We'll talk a little bit about where this is. So it's North Stack. This is a geological anomaly is where this package sits, the core of this system, the 13 wells. So it's.
You might ask them if anybody knows what an astroglean is.
Yeah, has anyone ever heard of an astroglean?
Somebody in
or
here
an
does
yeah.
because I've discussed it with
Yeah,
them. Okay.
I think it's from a meteor, is it not?
Correct. So
Yeah,
however long ago you want to say, a meteor hit the Earth.
yeah.
Right here in the middle of this system, and created, crushed the geological formations, and you could probably speak to it better than I could.
Yeah, amazing field.
Yeah, not a geologist. So this happened, created a geological anomaly. The heart of this package sits. This is roughly a 10 square mile asteroid that hit the Earth and the impact zone. So it's produced millions and millions of barrels of oil and gas, and there is still a lot to recover. If you want to go to the next slide, I can kind
Oh, wait, one thing. This is the one in 79.5, I think a billion goes there, doesn't it?
Yeah, that's
of
correct.
billion cubic
Yeah,
feet.
That was the type of it. I saw.
Yeah. Yes, billion cubic feet.
Here's my dilemma, whether to name it Total Production Partners or Total Astroglean Partners. What sounds good?
Scott, I like astroglean.
You know, yeah.
We're getting ball hats made, the astrogleams.
You ready?
Yeah. So this is a map of the assets included in this package. One thing from an operational standpoint, we know the leverage of being close to these assets. They're all contiguous. They're within a few miles of each other. It cuts down on operational costs. We're going to be opening a field office just outside of this area, and this circle here is a rough indication of where the astrogleam sits. So inside of that, we have 22 operated assets. 13 of those are lined into the central disposal system, and then there's an additional 19 non-op and overrides. So the entire package is consisted of these counties here, and all relatively contiguous. But we own leasehold acreage in most of the sections that you're seeing up here as well. So there's opportunities not only for what we're going to do, but for what other people propose, whether to participate, to take an override, or how we can increase production.
Yeah, quick correction. We would be acquiring leasehold in almost every section that's out here. So
Correct.
it comes with the package.
Correct.
We don't own it currently. It would be part of this package. So.
Yep. I'll stop here if you guys have any questions about any of this.
Yeah,
so
feel
far.
free to ask questions as we go forward here. It'll help bring out more detail.
Absolutely.
one of the things that I like about this, is in terms of, we were talking about just different risk profiles. This is a much lower risk profile than drilling wells, because the drilling risk is gone. There will be some tax benefit. Clayton and I have met on it one time. We'll probably have numerous other meetings, but, another thing, you're entering the production curve after the decline. And you're buying this at the point where these assets are virtually flatlining with very little decline. And these guys have methods, or hopefully you're gonna talk about that today, where they can maintain, possibly enhance that existing production. So we're talking about buying an income stream that's there from day one, immediate cash distributions the month after we buy it, and at double-digit rates that create a payout, and then could be 4 years plus or minus. 25% on your money, current monthly, with some tax benefit, with virtually no risk, no drilling risk anyway. So
Right.
these are some of the things that appeal to me, and I think will appeal to a lot of our partners that are looking for income.
Yeah, and another thing, just to touch on that before we get into the optimization, is that it's spread out amongst so many wells. The bulk of the production does come from those 13, but it comes from 13 wells, not 2 or 1, where if you do have an operational issue on one well, you're still getting a check that month. So it's a lot more stable than a drilling program, and there is also opportunity for those of you that like the risk, that there's gonna be opportunities of drilling programs within this with the HBP acreage. And one of the benefits of this, that's probably different than a lot of different operators. The current operator right now has vastly outgrown this field. So initially it was a great moneymaker for them. It kind of put them on the map, but the potential of a 50 barrel a day well is just too small for them to worry about. And so there's a lot of additional infill drilling opportunities within this that would be great wells for us and for you all, but for a major corporation, it just doesn't fit the bill. So there's a lot of opportunity out here that's yet to be explored.
It's also been well operated, but not necessarily efficiently operated. So, like Craig was saying, I cut my teeth down in Pontotoc County, which is by Ada, which is wells that are 2,000, maybe some might be 4,000, but it's really shallow wells that you have to operate efficiently. And there's lots of rich people down there that have, you know, I can remember when I started when I was 17 and I came to Oklahoma, and I'd see them, and they had all these little wells that make 2, 5, 6, 7 barrels a day, but they knew how to run them. And that's what they're gonna show you here. But these wells that we're buying, they've been operated properly, but they're not, they haven't spent the time to go and say every zone they might do, every way they can make it more efficient. Can we drill another well, like you said, next 50 barrels? Tremendous opportunities in these thousands of acres we're gonna have. Plus, you can ask them any financial questions you want. They've gone through them. This thing has been profitable every year, the 5 years we looked at.
Yep.
Majorly profitable. So go ahead, Craig.
So,
Sorry.
one of the things that, when we first started doing this, what we found is that the most expensive operational cost is workovers. It's going to be a $10,000 bill every time that you have to pull tubing, and so if you can reduce that number, all of your economics look much better. And so we went on a hunt to figure out how to optimize runtime while maintaining production. So you don't want to give up production by not running it. That was one way to do it, but just having efficient strokes. And so it's estimated that over 90% of wells in the United States are over pumped. They're pumped past the point of efficiency to where your fillage of your pump is actually decreased below 75%. And at that time, the whole rod string moving up and down they call it pounding fluid. And so when you pound fluid, the weight of the rod string comes down, falls down, however many thousand feet deep you're going, and it smashes the fluid because the pump isn't filled all the way up. So when that happens, it creates a ripple effect that goes all the way up. All of your rod string is essentially damaged each time, and it goes all the way up to the surface equipment. It's not good for anything, including your pump. And so you have a lot of damage from that. The rods can actually wiggle and rub against the tubing. You can cause tubing leaks. You can cause all kinds of issues. So that was our first goal. We found a company that was founded by a group of MIT students. They're actually located in Boston, which is kind of an odd place to go for oil and gas, but they have a software program that utilizes hardware and software. So we install their equipment onto our wells, and it gives us remote access to it. We can show you, Kelly, pull it up on your phone real quick. So we can see our wells in real time, each stroke. So this is called a surface card. I don't know if you guys are familiar with these, but a lot of them they're called dyno cards as well. So this is actually surface. There's also a pump card generally that goes with it. But this shows you as it starts to pump off. So a good card would be full where.
Use your stick.
Okay, sorry. Where you see it, this is the upstroke, and then this area is the downstroke. And so as it starts to pump off, this bottom line starts to move closer and closer and get more shallow, closer to the upstroke. And that indicates that you're pumping off your well. You can see here, this is called pump fillage. So this line at the top is 100%. So we're showing 100%, 100%, 100% for several minutes. Then it starts to dip down. Then we start to see dramatic fluctuations of that pump fillage. So
And I'll interrupt because I'm a landman, so I'm not the smartest guy in the room. And I didn't know when I saw a well, and they showed me this, it was very interesting to my brain because you have a well that's making 3 barrels a day or 5 barrels a day. And the well, pumps off, literally the fluid's gone. And so it's just creeping in. So when I saw this, I could see that makes so much sense. Instead of just tell them about the timer. They explained to me how old-fashioned timers work. Because you'll have wells on a timer. You'll see them come on and go off. And they're doing that because they know there's not enough fluid. This takes it to a different level. So you actually see the moment it pumps off, you can turn the pump off instead of guessing like a pumper going out there.
yeah, if you had eyes down hole, the reservoir refills the well bore at a certain rate, right? And there's a lot of factors there. But the reservoir creeps into the well bore, and it comes into the pump, and then you actually pull the liquid up the tubing string. So if in a perfect world you would match your pumping stroke with the rate that it's coming and refilling the well bore. The problem is no one has eyes down hole, so you have to use different instrumentation. And this basically gives us a really good insight of what's happening. So when we start to see that fluctuation, we know that we need to stop pumping at that moment, let the reservoir refill the well bore, and then start it up again and get more efficient strokes. And what we've seen is quite a bit. We'll get into that in the next slide, but we've seen reduced failure rate for sure. And in a lot of cases, we can actually increase, we see increased efficiency on them, but a lot of them we can increase production as well. Because the more efficiently you run it, the faster the well bore refills, you're pulling on the right stuff, and you end up with less runtime with more production, which is a win-win on both sides. You were saying, the traditional timers, they've used timers for, probably 100 years. Yeah, so a timer right now is the major brand is called a torque timer. It runs in 15 minutes. It's like a kitchen timer almost, or like a lights, like a Christmas lights timer, where it winds and every 15 minutes you can control whether it's running or not. Well, a lot of these wells don't even need to run for 15 minutes straight, but that's not an option. So with this, we can actually stop it every 5 seconds if we wanted to. Not a real reason to do that, but you can. And so we actually get it down to the exact moment, let it refill. It ends up having more run times, more pump runs with less time that it actually runs in the day, and it'll make sense here in a second. And we end up with more production. Any questions on this?
It's interesting, looking at how they've done it for 100 years, you've got a pumper that has to go out there every day, and he puts his hand on the pump jack to feel the vibrations, to see where they're at. And then he'll set a timer, estimate what he thinks it might take, and in the meantime, he runs off to another 20 wells that day, and the well's over there pumping out the bottom, and it's like, it's not an efficient process.
Yeah.
When they showed me this, and you'll see the results, they've got documented case histories. This is amazing. You can buy existing production packages. We've got a built-in advantage to maintain or actually enhance production and reduce costs.
Right.
And no one else is doing this.
The second, just to piggyback on that too, is the second benefit, besides less failure rates and thus making your LOEs look better and your expenses going down. making more production. Those are two very good things. But the third is that you have remote control of this unit. So if you do have a spill, it actually comes with cameras so we can see the wellhead. Happens all the time. You have a little bit of leak on the stuffing box rubber and you've got to tighten it down, but your guy may have already been there that day and now he's off to his 50 other wells and he won't be back for another 24 hours. And if you can shut that unit down remotely, see the problem, shut it down, and then come back and fix it, then you end up with potentially avoiding the, some kind of environmental issue, which can get pretty costly as
And
well.
with the new 5G, where it's available in most of these areas, the data is real time, or close to real time, which is really impressive. It happens like this.
One thing too, before I was about to leave, but I promise this is my last thing on this slide. But a real case study of what we did have is we put this on on this well in October, and 3 days later it told us that we had a worn traveling valve, which you could see from these pump cards. There's indicators in these of telling you what's wrong downhole. So it told us we had a worn traveling valve on a well that was
The AI actually came out
Correct.
with a bleed
Yep.
and told you you've got a worn valve
It's-
and it's gonna fail.
Yes,
Yeah.
yeah, so it was an automatic trigger from the software saying, you have a worn traveling valve in this well. Well, the indicators to us at this point were, it was making its normal oil, it was making its normal water, and it was a little bit down on gas. So we were like, this is 2 days in or 3 days in, I don't know how much I trust this. So we let it run for a few more weeks, and I actually got a dyno card from a traditional guy, which we normally do, shoot a fluid level, and he comes and takes one of these, a snapshot of like 5 minutes. And he came back and he told us, you have a worn traveling valve, and your fluid level's rising, and all of that indicates that that thing was correct. We pulled it, it went back to normal production. But what that saved us was several more weeks of letting it just peter down to lower production. We knew what the problem was. We knew it wasn't any kind of issue with the tubing, so we didn't have to pull tubing. We just pulled the pump. Saved us about $5,000, and we knew it 2 weeks in advance of what we normally would have if we had waited. So it's another just example of efficiency that this technology helps us do. That no one in this space doing this kind of work with these kind of assets has anything like this. They're fairly new. We've worked with them since October, but we've already seen the results, which are here. So these are our wells, and this is historical production here, and that's what we've been able to do since we've implemented this new technology. And it may not look like a very big difference, but you're looking at a 12% increase in barrels per day right here, and going from 24 hours of pumping to 5.5 hours a day of pumping. So we reduced it, I don't know what that percentage is, it's a lot, 75% or so of runtime, and actually increased production. Same thing here, this one was 24 hours a day, making it on average 9 barrels a day. We're down to 18 hours, it's making almost 11.5. This one it was on timer prior, and was a great well. It made 5.3 barrels of oil a day and 1 barrel of water. That's a winner, running 4 hours a day. But we were seeing that it was actually pumping off in less than the 15 minutes. So we reduced that pump time, but increased the amount of times that it pumps per day. And now it's going about 2 hours, and we saw an increase in production. So it's just doing it more efficiently. Same thing on gas. This is a good one. 24 hours, 9 barrels, 90 MCF. We've got it up to 11.5 and 160 MCF on 10 hours of runtime. So we've essentially over doubled the lifespan of this well in theory from wear and tear, and are making more production from it. So none of this stuff, none of this package that we're looking at today has this on it, or has been utilized like this, or has been closely monitored, because it's just it's a legacy package that they would consider marginal.
So we're buying it on a valuation that we believe we can improve on production wise.
For sure expenses, without a doubt, but hopefully also with production.
You're gonna talk about the energy time frame?
So that's another thing, another benefit of it is that we can actually optimize it based on its runtime to run in off-peak hours, so that you save on your energy bill as well. You're gonna save a ton just by reducing your runtime this much, but then if you can also optimize it, which their technology helps us. We can put in the data, and it will tell us when to run it at the right times, so that you actually decrease your energy bill in a way that's significant, and you know, hopefully
So
increase your
you can
production.
run it in the middle of the night instead of when the pumper's there during the day. You save, and at the end of the year, you save 10% on energy, and you multiply that by 50 or 100 wells. You've made another fortune that
It
year.
could be more than 10%, because night rates.
I'm just saying it's-
considerably less.
Right.
The exciting thing about the technology, go ahead, sir.
This is, this is good.
This is state of the art.
I've-
Artificial intelligence.
I have never heard of it. I've never heard of it.
I know, nobody else has either.
I mean,
When do you hear about?
I'm psyched up here.
When do you hear about the cow in the
Oh.
pump jack? When do you, it comes across and it says, it said, you got a cow in your pump jack. And they go, how did it know that? Sure enough, they went out there and a cow was stuck in the pump jack.
You just,
No, I'm
you
not
just
kidding.
love AI, right?
Yeah.
Tell them about the rain, Craig.
Yeah.
So these guys are all French. They went to MIT, but they're Frenchmen, and so we were on a call with them. And there's a little bit of a language barrier. They speak English well, but it's very. Yes, exactly. Only when they want to, no doubt. But we're on a Skype call with them, and one of the engineers said, "Hey, it looks like you had some rain on this well last night at this time." And I was like, I don't live in the area of this well, so I didn't really know. I'd have to check. He said, yeah, I could tell because the belt slipped at this time, and that's from rain. So, to give you an example of that, is that, you know, if your belts burn up, this thing could shut down if it detects, if we told it to, we would say, okay, if there's rain in this well, and it detects belt slippage, you need to shut the unit down and save those belts. Because otherwise, the belt slip, it will burn, and the pumping unit will stop, but the motor will keep running.
And you burn a motor up.
You either burn your motor up, or your belts are gone, and it's not working for you. And so, all of those things are also built in. The cow thing was an interesting wrinkle that we weren't expecting, but it helps you have a pumper 24/7 that's better than a pumper who can see downhole, and we've seen the immense benefits from it, especially with production packages like this, because you can optimize them and you can buy them for one price and then make them better every single time without fail. It's not junk science. It's not a sales job. We've done it. This is what works. We can increase the production and the efficiency 100% of the time.
So from an investor standpoint, we're buying an asset, the big decline curve's already over. We're buying at a relatively flat decline curve that we have the ability to enhance. And one of the things that I'm looking at is doing a series of these offerings, like we do on our drilling programs, and do one every year, or potentially every time they have a package. We take a big piece of it, and we build into that. If somebody wants liquidity, we could offer, and don't hold me to this because we're still in the due diligence phase. Clayton's back there laughing. But we would have the potential to offer our partners who invest in this a liquidity on an annual basis, or each time we have an offering, to where we could include that revenue stream based on the same multiple in the new deal, and give people liquidity in the investment, which would be a huge advantage to a lot of our partners.
What is your initial cost to put that in per well?
So it depends on the well is the best answer. It's going to cost no more than $1,000 per well. In a lot of cases, it's closer to $6-ish. But it depends on, if you sell gas, then you want to have a pressure sensor on your casing as well as your tubing. That has an additional cost. And then
Tank monitors, cameras.
tank monitors.
You can build onto each well as robust as you want, but we could outfit a 1 barrel a day well and still justify the cost.
It can control compressors, saltwater pumps. It just depends on the lease. So it's going to be no more than $1,000, but likely in most cases somewhere in the $750 range. I would think.
We're gonna build in a CapEx, working capital, based on the package that we buy,
Yeah.
to equip it immediately when we buy these things, it'll be part of the package.
That's built into the offering.
So this is their current financials They gave us kind of a weird time frame, so I'll apologize, but it's essentially June of 1 year to May of this current year. The overall package has made money every year for the last 5 years. Through COVID, through really bad oil and gas prices, and then as they prepared to sell this, they actually invested an additional $1.5 million in CapEx. So on average, their CapEx over the last 5 years has been about $350,000 to $400,000 a year. In this 12-month span, they spent $1.5 million. They had let some assets that were working fine, that just needed a pump change sit, and so they didn't go out and didn't fix them. They didn't.
They took the production from where to where when they did that.
Yeah, so they were averaging about 100 barrels a day, and just from since they completed those to now, it's up to the 128. So these numbers, I can show you in another slide, are all based on about 100 barrels of production, net barrels of production, and since then, we're up seeing over 125 to 130 barrels a day of sustained net production.
So this is historical, this is what they recover.
Yeah. So this is their pricing. All of our modeling is done, like we said, at $70 oil and $3 gas. And so at current production, not changing any of their expenses, we know that we can break even or pay back in roughly 4 years at $70 oil. With this technology, with the way we're going to run it, we know that we can bring down their CapEx number and reduce failure rate and reduce that even further. So in our minds, a 4-year payback is a very conservative payback, and how to extrapolate what this is going to look like is a little difficult on a well-by-well basis, but we know that the savings are there based on strictly failure rate.
Yeah, if we acquired this and ran it the exact same way, the tier A operator with multiple hundred employees runs it right now, we would have the payback time in less than 4 years. If we do it the way we think, and the prices stay in a relative, it still made money at 48 and 138, so that's pretty good. If we can do this better than them, which we think we can on some efficiencies, then that payback period should decrease.
Well, and also, if you believe energy prices may be higher in the future,
Right.
that also adds a lot.
The beautiful part about it, though, is when you're averaging $48 oil and $1.38 gas, and you still get a check rather than a jib bill. That's what we're looking at this and saying it's a pretty low risk investment.
This Astroblim is one of the most prolific areas, home. Again,
Yeah,
Forget-
don't mention any names here, Ken.
forgive me, but that is a great play,
Yeah.
okay? And
There's
I've
a museum there.
yes, I've always wanted to go down there. I've seen it on the road out to Towson. Go see the meteor. But this is a great play, and I've always wanted to get in the play, guys. I'm serious. I'm not a ringer. I'm not a ringer for you either.
You don't sound like one.
But that's exciting.
Yeah.
Yeah.
It has a very robust history, even within Oklahoma Energy. It's got a very, very great story, and
Yeah.
is a great play in a geological anomaly that only 6 meteors that have ever hit the Earth are in hydrocarbon producing areas, and this is one of them.
That's a wonderful thing, guys.
It also
I'm
has,
psyched.
there also is when you look at the projections, the amount of oil that's left in there is amazing, but you have to deal with the water. And so this water system that they spent millions of dollars doing, truly millions of dollars, it can handle more water. What is the number that's at now?
Yeah, so roughly, around 3,000 barrels a day of water produced, and the disposal system could handle 3 times that. So.
You may not have it handy, but what's the difference in production from June of 19 to May of 23? I see the dollars, but what you don't know there is what happens in the production. Was it rough? Given that you
So-
go down the curve, you go up to the flat.
Yeah, so this time frame, they took one well and they popped a zone in it. That well increased, and they averaged about 150 barrels a day during 2019, 2020. That well's now down to its, I would say, flatline production on what they got back. And so these 3 years are right at 100 barrels of net oil production. And I've got it in the next slide. Roughly 700 MCF, 600, 700 MCF. So this is each one of those years broken out, and the next slide has the other one. So you can see they were at 158 barrels here, but we've averaged 99 barrels per back, 100.65 and 100.32. So
So go back to
Good
that other
question.
slide, go back to that one.
Yeah.
So this is COVID, show them COVID here.
yeah, so during COVID, you're right at 100 barrels of net production, between these 2 years, and we're still cash flow positive. The exciting thing is with them not having paid attention or as much attention to this as possible, with investing the capital that they did to get it ready to sell, they didn't pop any new zones. That's not any of that. None of that was exploratory. That was just strictly bringing assets back online that needed to be brought back online. And we're up to 128 barrels a day. So that's not a flush production, and we're gonna flatline back to 100. So
This is what I like though, is it made 2.6 million with 80, but then the money spent, it still made money. It's the same price and making oil, but they got their money back. So you go look at the production, the money they invested, they got it back. And so that year was less than the prior year, even though the price was the same, but it was still very profitable, so.
Something you didn't mention, or I don't know if it was clear, is that there are other behind pipe potential reserves you can tap into in existing wells. I didn't
For
hear
the
you
next
talk
25 years, we'll be tapping into the Prudential Reserve.
Yeah.
So
Much,
there's
much less
up-
drilling new wells.
Yeah,
in the
I'm saying
existing
there's
well.
upside in existing well bores.
Right, but you don't do that on a well that's producing, you wait,
Right,
you're gonna,
right.
maybe 5 years, there's stuff behind pipe on.
nor are we paying for that upside. We're paying for the production that's coming out of the ground now. And we know that there's gonna be opportunities once that starts to deplete to come back up whole and recomplete in potential pay zones. So we're buying what they're producing today, knowing that we can make it pay back in 4 years, and then hopefully reduce CapEx and spend, and, see nice $80 oil prices and return that money faster. But I'm happy to answer any of the financial questions too.
And
We
Kyle and
can-
Caleb know.
Yeah, we can dig into it if you'd like to sit down and go over any of it. I've got much more detailed statements and everything else if you'd like to see it.
You mentioned override, does that mean us drilling wells, does that mean somebody else drilling the well in the area and we just taking over?
Correct, someone else drilled the well, so those are all on non-operated assets. So there's 34 non-operated assets, plus an additional 62 non-operated assets that we own overrides in.
The total number of well bores we're participating in this program is what?
Is 100 and, what is that?
40 something?
Yeah, it's right at 130, 129.
149 well bores.
So,
So you've got good diversification, producing assets, flatlining, assumptions at low prices. I looked at the production package before I talked to these guys and was ready to move on it. And for reasons, a lot of reasons, it didn't work out. But it got me to looking at the economics and thinking about, and then when I heard this story with the enhanced production, the AI, technology, software, I think we've got something here that's a real winner. I think
The other thing on the override, which Steve touched on in the very beginning, is that they took an override in those wells, but they still maintained all the zones outside of the one that they got produced. So even on those ones where it's just an override and we may not have operated interest in the well, we still own the zones, except for likely the Mississippi in those units.
so he's explaining from a land perspective, I was just gonna do
Yeah.
the same thing. So if I have and these are old leases, so the old leases, they'd get a lease and you would lease and you'd have from the surface to the center of the earth. You own that, okay? So most of these leases, that's what we're buying. Someone comes in and says, I wanna drill a Mississippi well, and you say, I don't wanna participate. Well, they get the Mississippi, so you're out on the Mississippi, but you own everything else above and below. So we have an override in the Mississippi well, and we own above and below. We might be producing another well of a different zone in the same section, but we'll still own those rights. So we can go back in, or someone else comes in and proposes a Woodford well. we'll own the Woodford, and we can decide as a group, we participate. All of that comes with it. So you guys, Total is buying the, the acreage along with the,
Well, we're
production.
involved in a land play.
That's right.
On the land side of the deal, which is something we've really never been involved in that much before.
But our
Because-
group, though, I'm a 40-year landman, and so I'll understand how to manage that part. How do you make the most money? Do you participate? How you negotiate with someone to get a good farm out with them? That's the stuff we'll handle. So we've got our team is pretty diverse on that side of how we can handle internally making those decisions.
I think this is kind of like buying a certificate of deposit.
It's not bad. I'm not. We're buying it too, so it's not
Yeah.
BS. It's just it really is a nice package. And if you manage these properly, if you manage them poorly, you can go broke too. If it's stripper wells can. If you just think it's a 100 barrel a day well, you can't. You have to take advantage of equipment not breaking. You have to watch it. I mean, the fact that you can get on your phone right now and turn that well off is unbelievable. And then we can sit and take a well that's making 3 barrels and make it make 3.5, and pump it for 2 hours a day instead of 8 hours a day. That's like a miracle in that world of economics. Because these wells will make oil. They're gonna make oil till most of us are dead. And that's the exciting part. It's gonna be making oil and the checks will keep coming.
If you remember Randy Holloman?
Oh, yeah.
One of the things that Randy taught me is mid-continent assets, which is what these are hard rock reservoirs, and they give up their hydrocarbons slowly over time. So these are real long life reservoirs. So we're talking long life production.
And we have reservoirs that we haven't tapped, and that creates a whole nother life.
We did we had third party engineering on this done about a year ago, when this package has come back to us. So when we got that done, I think he initially gave it to us and we had to tell him, hey, you need to cap it back, cause he put like a 75-year, economic life on the package, before it would be upside down. There's no telling how long it will go. We had to cap it at 25 for our purposes, because that's how we do it internally, but he had put on there a 75 year economic lifespan.
We expect this to come down pretty quick. We're anticipating close in February, which means we would have income generated and be distributing monthly income second quarter of 2020. Our end of the deal is going to be about $4 million. Yes, Cap?
Well, I was just wondering, negotiations for purchasing this production, are they wanting to get rid of this production? Are they asking a fair value, or are they wanting more than what you're thinking?
So,
how's that go?
So the way it works for us is, this deal in particular, we'll just talk about this one. So we have a few contacts at this company, and we had told them that if they ever had assets that met these criteria, that we would like to be in the running to take a look at it. And so they brought it to us, and they said, make an offer. And there were several other groups that made an offer as well. And we ran it through these, all of this, where we took their data, came out with a valuation, and said this is what we would be willing to pay for this. And our valuation, like Caleb said earlier, is based strictly off of what it's producing today. We don't give any value to land, we don't give any value to upside, it's just PDP value. What does it produce right now? And then we made an offer to them. This was back a year ago, so the first time around, and then they ended up going with a different offer, and it was a little bit of funny money, I believe. So we had a tried and true. We were going to stick with our bid, and then when they came back around, we actually decreased our bid a little bit, and so it's a very fair number in our mind. It's backed by real data that's theirs, not ours. It's nothing taken out. We took their numbers and said, what is this thing worth? And
How long have you been working on it?
Too long.
yeah, I would say that this is over a year. This has been about a year and 4 months, but a large portion of that it was intended to be sold to a different group. So we were really heavy on it about a year and a half ago, and then we took a hiatus when they decided to go with a different group, and then they reapproached us a few months ago. So we'd already done all the legwork. We updated the data with their new information, and then made an offer, and they are they've accepted it in theory, but we are waiting on one signed document for it to be officially official.
And there's no other parties involved.
Yep, it's just us at this point.
No other
And they've
vendors.
had a PSA that's been redlined and gone back and forth.
Yeah.
How many times?
At least 4. Yeah.
So very, very, very close.
Yeah.
Do you have any idea what caused the other group to back out?
Yes, they did not get their funding. So it was the group that came in after us actually doubled or more than doubled our purchase price. So they were like, well, we have to see if this is real, and then it ended up not being real. I think it was some foreign money, and they couldn't get their funding, and so the deal fell apart after about 9 months. I think.
I think you mentioned it, but how many properties are in the Astro Blim? I'm back to that again.
22 operated and 19 non-operated.
That's the majority of the production.
Yep.
It's in the Astro.
That water gathering system is located within the Astro Bloom. Yep.
Thank you.
Okay, guys, we're getting close to cutoff time. Any more questions on our total Astro Blend partner?
Do you have more due diligence to do?
Yes, so we have done none of the field due diligence yet. Everything that we've done has been in the office. We also need to run the records, so title work has to be done. We anticipate that it's going to be pretty simple title because they drilled most of it. And it is a very large company that usually does stuff of record in the correct way. And they've owned them for a long time. They've been in this area since the 70s. So it should be pretty simple title work. Field, I imagine that it's going to be pretty simple on the field side as well. Just
Tell them what you do with vendors in the field.
yeah, so I've already got, I don't know, probably 20 different vendors of ours lined up to have a couple of days where we're going to go out with different roustabout groups, chemical companies, people that do road work and build, everything that we need done on location. They're going to come out with us and give a survey of what they think of each site. And so we'll get a report back from all of these different vendors of, a lot of it may be some fluff, but at least we'll have multiple eyes on it to say, hey, these are the things you need to be looking for. You may not need to do this right away, but yeah.
When we get to that point, can anybody say field trip?
This would be a cool field.
Yeah. All righty. Any more questions, guys? Where are we? We're a little after 1. Trying to stay on time. Okay. Steve, Craig, Caleb?
No, I appreciate you guys, and like I said, any questions from the financial side, these two here, they know the numbers, Kyle and Caleb do.
I dream about them.
Yeah, they've done a lot of work, but it's impressive because they're not showing you the spreadsheet here where they can go well by well, asset by asset, and pull it apart. And we've looked at every angle of this, and I'm excited because I know from a land perspective, like Craig said, it's not going to be that hard on the due diligence, but we're getting some gems here that we don't know about yet. There's some things inside of this that are gonna do really good things for all of us. So I'm excited about it. I really like it. I like the fact that it's coming from one place. I like the fact they've owned it a long time. I like the fact that it's not that important to them from a day-to-day, paying their bills. There's some good stuff here.
Okay. Any other last comments or questions from anybody today? Thank you all for being here.
Thank you, Scott.
And reports will follow.
Yes.
And we'll move forward into the new year.
Merry Christmas.
All right. That's right. Happy holidays.
Thank you.